We have breaking economic news. Inflation numbers for January have just been released. They have come in lower than expected. Annualized inflation in January ran at 5.9%, according to Statistics Canada. That release just hit the screen moments ago. As we told you earlier, economists had forecast an increase in January inflation on an annualized basis of 6.1%. So where 6.1% was expected, 5.9% has just been reported, a lower number than expected. It's also meaningfully lower than the 6.3% reported in January. A slightly different picture when we look at core inflation, which excludes the impact of volatile fuel prices and food prices. That number comes in at 5.00% as CPI core median. There are two different versions of core inflation, median and trim. Both of those numbers, well, the median number comes in slightly stronger than the 4.9% that was expected. The core number comes in slightly weaker than the 5.2% that was expected at 5.1. Let's bring in an expert for analysis. Dominique Lapointe is global macro strategist at Manulife Asset Management. Dominique, thank you very much for joining us. The big question is, does this give the Bank of Canada room to pause on interest rates, not to raise rates the next time it makes a policy announcement?
Definitely, because the data that we've received, not just in Canada, but globally over the past 2 weeks, suggested two things: stronger and more resilient growth at the start of the year, which would feed into more sticky than we'd want inflation data early in the year, and that led many observers to think that we need more rate hikes and leave those rate hikes for longer. So in contrast to the United States inflation data we've had last week, the Canadian data is showing clearly, surprisingly, more disinflationary trend at the beginning of this year, and that for sure that will comfort the Bank in Canada going into the March decision.
We have also received just minutes ago new retail sales numbers in Canada. And the big takeaway here is that appears to be that retail sales, when you exclude automobiles, which of course are big ticket items that can skew the numbers one way or another. So leaving aside automobile purchases, retail sales fell by 0.6% in December. This is a December number, not a January number. The value of all retail sales, excluding automobiles, fell by 0.6% in December. That is a much steeper decline than the 0.1% that economists had expected. Same question, do those retail sales numbers fit into the disinflationary picture that you just talked about?
Yes, and it's also, the fact that consumption is slowing on the retail side is actually a positive development. We had started to see slower goods consumption in Canada in the third quarter, and what the data confirms today is that that slowing momentum carried through Q4. Now, I want to point out also that when you look at retail sales consumption on a nominal basis, we are miles away from the pre-COVID trend. So it's expected and normal that the pace of that there's a contraction into the amount of goods that households in Canada consume as the effect of interest rates unfortunately hurt some of their pockets.
Help us understand these core inflation numbers. First of all, as an economist, which one do you pay most attention to, median core or trim core?
So we have a lot of core inflation data in Canada, unlike the US where they only have one, which is excluding food and energy. The one we pay attention to the most is the one that the Bank of Canada tells us that they pay attention to, which is both CPI trim and CPI median. There used to be CPI common, but they are revising the methodology so far. So we're looking at these two. And it's important to point out this morning that going into the release, we were expecting some upward revisions because Statistics Canada told us that they would revise the seasonal factors going back. So it's not a surprise that we do get some upward revisions into CPI median, especially. But the fact that it slowed down by quite a bit in January is encouraging because our opinion looking at the US data, was that these measures would be revised up and stay flat. So again, this is a positive development this morning also on these core measures.
Again, for viewers, the headline inflation number has come in significantly lower than economists had forecast. That number is 5.9%. The annualized pace of inflation in January, from January of 2022 to the end of January 2023, economists had forecast 6.1%. So it's 20 basis points weaker than the economists forecast. It's also 40 basis points less than the 6.3%. That was the December figure. So the question is, Dominique, can inflation track downward as rapidly as the Bank of Canada wants it to by the second half, by the end of this year, let's say?
It's not that rapid as a decline. They don't expect inflation to go back to 2% until, I think, middle of next year. What we do see, though, is in the near term, the base effect, so the fact that commodity prices have rolled down, and that feeds through a lot of inputs for businesses. What we do see is some disinflationary pressure until at least the beginning of the summer. And then the question is, what happens then? Will there be an inflection point where those disinflationary pressure that just comes from the data sort of slows down? And are we going to see a pickup in inflation towards the middle of this year? And that is the upside risk to the scenario. If the economy doesn't slow down as much as central banks think, and we end up in a situation where core CPI refuses to slow down this summer, and then central banks preemptively could want to raise rates by a lot more. And then we could go into a situation where there might be a chance of a softish landing to somewhat of a harder landing, but we would only see that coming through at the end of the year because of the delay for which interest rates actually impact the economy. So that's the risk.
So let's go back to the Bank of Canada. It sounds like you are expecting the Bank of Canada not to raise rates the next time it makes a policy announcement, correct?
As the Bank of Canada has said that for raising interest rates more, they need an accumulation of evidence that inflation is not going back to target and that or growth is much stronger than they think. And so far, we've had two data points to look at, which was the January labor force survey that indeed was a blockbuster. But when we looked under the hood, we noticed that there are as many new people entering the labor force as there are people actually taking jobs. So in our opinion, in our team, this is not that inflationary, the fact that we're getting more workers, partly coming from immigration, they're taking jobs, doesn't necessarily lead to stronger wage growth. And then we have the inflation data this morning that is surprising on the positive side, showing stronger disinflationary pressure. So combining those two, so far, in our opinion, we haven't seen these evidence that the Bank of Canada would be looking at to resume their interest rate cycle. And also want to point out, if they indeed decide to resume their interest rate cycle, it's not going to be only one rate hikes, right? So it's not a decision that you can take lightly starting raising interest rates again. It's something that would have a profound impact on the economy.